Right, let's not fool around. Let's get straight into the questions. Adrian, question from Pybus. He says, this sounds all great. Are there any brokers that do this type of investing, or do they not diversify to spread the risk? Would you get a brokerage that would only do value investing?
Brokerage is going to generally do execution. So they may have a bias in their views. They may have a philosophy that biases them in one direction or another, but a brokerage by definition is defined, the definition is that it's going to execute for you, so it's going to do what you instruct it to do.
But within a brokerage you would get people who specialize in value investing.
It's more likely though that you will find in my part of the industry, which is the investment management part of the industry, that's where you're going to get more clear evidence of the philosophy that drives the investment style.
In your asset management company, I mean, I suppose it would be really difficult to break it down into a pie chart, but what do you reckon, what sort of percentage of the money that you invest would be invested in a value portfolio?
That's a really easy question to answer. In my case, it's 100%. We only do value investing.
Okay.
And our specific style of value is what we call deep value. So it gets more complicated than just saying I'm a value investor. There are different brands of value investing, and we are deep value. So everything that we do.
What do you mean by deep value?
Well, we're going to go in search of companies where the stock price, for instance, is less than the cash in the company's register. So you're actually being paid to buy the business. Now, these types of examples aren't abundant on any market, but they certainly exist. And in South Africa at the moment, I can give you a list of 3 or 4 companies that have that exact characteristic, that there is more cash in the company's register than the company's entire market value after you've paid all of the company's debt.
Like who?
Well, a really good example of this is a business called ELB, which is an engineering company. Mm-hmm. They have 35 million shares in issue, a share price of 13 Rand. So that translates to about 450 million Rand market cap, which means it's a tiny business by South African standards. They have no long-term debt to speak of, 20 million Rand. And when you go and look at their balance sheet, which you referred to earlier, you take their current assets, which is 850 million Rand, you subtract their current liabilities, which is 500 million Rand, and you have net current assets left of 350 million Rand. They happen to have 350 million Rand cash on the balance sheet, and the intriguing part of this company is they have bought back 10 million of their own shares. So the 450 million Rand market cap is actually overinflated because the company has bought back 10 million of the 35 million shares in issue.
But now hang on, let's just come back to this company now. Why would a company be sitting on 350 million Rand in cash in a market where the interest rate's going down and you're getting less and less return on your cash? Surely they should be employing that cash in something else that's generating more of a return.
Absolutely, and these are the types of questions that an active investor will start to ask, or an activist investor will start to ask of management, is why is all of this cash sitting on the balance sheet? Is this cash being optimized? And if it can't be effectively used inside of the company, it can be returned to shareholders. So under a perfect world scenario, you buy a large stake in this company, you're able to successfully engage management and get them to return the 350 million Rand to shareholders. Here you have a classic example of what Benjamin Graham, the father of value investing, referred to as a net-net. It is an example in which you are actually being paid to buy the company.
Okay. I want to move on now because there are loads of questions. Johan in Hartbeespoort put, excuse me, are these guys not cowboys? Are they not the ones pushing the safety barriers in the hope of a possible big return? Are you cowboys?
Wow. Value investing has 2 really fascinating attributes to me. Going back to the very first point in our discussion, I said that there are active and passive investors. Active investors are trying to beat the market. Only about 25% of all investors beat the market. So most active investors do not beat the market. Most active investors get beaten by the market. Intriguingly, that 25% of investors that beat the market are overwhelmingly value investors. Value dominates in terms of being the most successful strategy. And you will find this across all countries, all markets, any sensible investment period. Value is a dominant investment approach. And not only does it produce better returns than market, I think the question that your viewer is also interrogating is, are they doing this by taking huge bets? Are they putting money onto red or black?
Yeah.
No. Value does this with less than market risk. So you get the nirvana of investing, which is to not only get better than market returns, but to do this with less than market volatility. Paul Theron will give you another version of this.
Oh, we're going to speak to him next week about that, and I'm sure he will. A technical question here from Dan in Maputo. He says he's been told to look at companies, and Dan, Chana, you're going to have to bear with me here because I don't know what you're talking about, and I'm going to try and get it out of Adrian. He's been told to look at companies with PE ratios at the lowest 10% of all equity securities and where the PEG is less than 1. Let's talk English. Firstly, okay. I've heard this thing, PE rate. What is a PE? It's a performance equity, is that right?
Price earnings. Price earnings.
Geez, I got that one right on the button. Performance equity. Yeah, no, price earnings. Thanks.
You can make it performance equities if you want. PE refers to price earnings.
Okay, what is a price earnings ratio?
Very simple. It says that if I pay a 100 Rand share price, how much earnings is there behind that share price? So if there is 10 Rand of earnings, I'm paying 100 Rand to get 10 Rand of earnings. Okay. My PE is 100 divided by 10, which is 10.
10%.
At the moment, the Johannesburg Stock Exchange sits on a PE of about 16, which means for every 1 Rand of earnings, you must pay 16 Rand share price.
For 1 Rand of earnings, you must pay 16 Rand share price. And that's the sort of average running across it. Would that be the average of like
that's the market average.
Market average.
That's the market average at the moment.
Okay, so he is saying he must look for companies with PE ratios at the lowest 10% of all equity securities. Now, what are equity securities?
Okay, so equity securities are the 400 odd companies listed on the Johannesburg Stock Exchange. So there's 400 odd companies that are listed. You take those companies and you rank them by their price earnings ratio, from the highest price earnings ratio to the lowest.
And then you look at the lowest 10%.
And you look at the lowest 10%. So what this lowest 10% represents is companies for which you are paying the lowest price for their earnings. You're getting lots of earnings per Rand, in other words.
Okay, that
this
makes
is
sense.
what value investing is about. So
would you agree with that?
Dan and I are...
You're in the same...
Immediately we are mates.
Okay. Now, this PEG, what is a PEG that's less than 1? What's that?
Okay, PEG is a second iteration. PE is the same price earnings, and G here refers to growth. So it says that what they're looking for is price earnings growth ratio less than 1. Imagine our company that is sitting on a 100 Rand share price. It has earnings of 10 Rand. So that's the 10 PE.
Right.
It could have one of two prospects. It could either be about to grow at 5%, or it could be about to grow earnings at 20%. A PE of 10 compared to 5% earnings growth would be 10 divided by 5, which is 2, or a PE of 10 about to grow at 20% is 10 divided by 20, which is 0.5. And that would satisfy Dan's criteria.
Okay, and you're still friends with Dan based on that statement as well?
Yeah.
So Dan is a prospective value investor.
He's in the right territory, yes.
Right. Dan, you know what you're doing. Next question from Tsepo in Pretoria. You spoke about the net method. If a company is trading at 2/3 of its net current assets, The buyer is essentially getting all the permanent assets of the company, including property and equipment, and the company's intangible assets, mainly goodwill in most cases, for free. Would you agree with that?
Yes.
Does it make sense?
This is what I would call classic value investing, and more accurately in modern times, deep value investing.
Okay.
That you are looking for companies whose balance sheet is more powerful than the value of the company in its listed capacity. So there is more asset, free asset, than company value. You're being paid to buy the business. It goes back to the earlier example of the engineering company that I gave you.
Yeah.
These companies aren't abundant. You don't find dozens and dozens of these businesses. Having said that, right now around the world, at Canon we survey about 15,000 global businesses, and there are about 300 companies around the world trading on exactly this, where you are being paid to buy the business.
So there's 300 prospects right now around the world which would fit these criteria.
And you're going to be paid to buy it. The key here is to stay away from distressed assets. You don't want to go and buy assets that are in the process of slow or rapid decay. You actually want to buy assets that have been overlooked.
Okay, well, it looks like you can employ both Dan and Tsepo at Canon Asset Management. We're starting to wrap up now. What are there any particular sectors or any particular shares on the JSE that are offering value right now?
Absolutely. And the sector to me that leaps out in graphic profile is building and construction. Very, very popular 3 years ago. The sector got pushed onto very high PEs. We can say that now.
Yeah, we can.
Investors were euphoric about the prospects for building and construction. And in the last 3 years, that euphoria has evaporated. As a result, their ratings have collapsed. And you find a company like Avenge, which has a market capitalization of 16 billion rand. It has 8 billion rand cash on the balance sheet.
Oof.
So you pay 16 billion to own the entire company. They give you back 8 billion. You've actually only paid 8 billion for the business. Profit in the last year was 4 billion, earnings before tax.
Numbers are already stacking up.
You're paying 2 to 1 to own the business.
Adrian, thank you very much for your time.
Thank you,
Appreciate you
Jeremy.
coming in.